Welcome to Capital Account. I'm Lauren Lister here in Washington, D.C., and here are your headlines for March 2nd, 2012. Fresh off of the ECB's latest liquidity injection, are we still facing a Eurozone banking crisis? Well, let's follow the money, okay? 2 days after 800 banks lapped up 530 billion euro from the European Central Bank's 3-year LTRO, deposits at the ECB have shot up to a record 777 billion euro, more than $1 trillion, as banks choose to make a negative return on their money instead of engaging in this sovereign carry trade. Is this a sign that banks could be terrified of this?
That's how they get you. They're under the ground.
What the hell are those things? How could they eat a whole station wagon?
I'm talking about what could be lurking beneath the surface of Eurozone banks' balance sheets. And since we're on the subject of liquidity, Brazil has fired off another round in global currency wars in response to all that easy money. Brazil's stepping up intervention in the market and extending a tax on foreign borrowing to fight against developed nations that print. Now, Bernanke continues to defend the Fed's policies in response to its purported objectives.
At present, with the unemployment rate elevated and the inflation outlook subdued, the committee judges that sustaining a highly accommodative stance for monetary policy is consistent with promoting both objectives.
He can say all he wants. The finance minister says Brazil won't sit by passively while expansionary monetary policies continue. And Timothy Geithner, in a Wall Street Journal op-ed today, warns against financial crisis amnesia as he sees opposition to Wall Street reform. But is Geithner lucky people seem to have forgotten about his role in the crisis when 2 years ago people were calling for him to resign? We'll tell you what we think. Let's get to today's Capital Account. Earlier this week, we saw 800 European banks take the bait from the ECB and the longer-term refinancing operation. This is better known as LTRO or even ELTRO. It's 3-year loans at 1% from the ECB. So banks borrowed a total of about 530 billion euro. We've been talking about this earlier this week. Now, though, we have reports that record amounts of money are being deposited overnight at the ECB. Here is a chart of what it's been doing for a while. You can see it spikes right there at the end. That is the most recent number. The overnight deposits were 770 billion euro. That is more than $1 trillion. And if that's LTRO money, banks are making a negative yield on it, okay? They're getting 0.25% on their money at the ECB, while again, those were 1% loans. Meanwhile, Spain, it now anticipates its unemployment rate is going to hit 24% at 2012. Let's take a look at Spain's unemployment. Those are the number of people unemployed. It's been a major problem, only growing. And we see all of this have a really negative impact on what's going on in the Eurozone. It's really hard to discern how this is going to end up and what could, should, and should not be done. So let's talk to Mike Norman about it. He's chief economist at John Thomas Financial, and we are very happy to get his insights on all of these things. Thank you for being on the show, Mike.
And very happy to be here, Lauren.
Great. So let's start with the LTRO, because this second round that we saw of this operation, right after that we see a record amount of money deposited at the ECB. What is up with these banks? Are they just hoping they're going to have an opportunity to make some more money down the line and some better investments, so much so that they're willing to get this money at 1% and make just 0.25% on it?
Yeah, it's bizarre, really, when you look at it. I mean, they're willing to take that negative yield, but I think it speaks to just the worry and concern of the banking system in Europe. I mean, nobody, the interbank market is very cautious. That indeed is probably the reason for these ongoing LTROs, is this liquidity provision. But then what happens as soon as the ECB provides the liquidity, the banks turn around and put it on deposit at the ECB, earning a negative yield. I think it's in part just worry and concern over the solvency and the risk inherent in the Eurozone banking system, and also maybe it reflects the potential for a breakup at the periphery where they want to have their money in someplace safe at the ECB or maybe in German bunds, which actually I think yield lower than the ECB's rate. So it's just a very curious situation that we have now. And underlying all this, you have to remember, we still have a solvency issue. The liquidity injections don't deal with the solvency issue. And as we see austerity play out and economic growth contract further, that degrades the asset quality and performance of these banks. So the solvency, or the insolvency, I should say, gets worse, which down the road requires more liquidity injections, right?
Well, that's a really interesting point that you bring up. Let's talk about the short-term implications, because right now there's a lot of concern that policymakers won't be able to prop up sovereigns, and vis-a-vis that, they won't be able to prop up the sovereign bond markets. And so isn't there a vested interest in these banks, or isn't it in their best interest if they have all of this exposure to the bonds of these countries that are distressed now or going to be in major distress? Doesn't it behoove them to stock up on all this easy money so that they're protecting themselves against that?
Well, look, the money is a loan, right? I mean, eventually it has to be paid back. It's a long-term loan, but it's a loan nonetheless. I mean, it would be much better if the banks would have increased equity, right? But you can't do that in an economic environment where you see growth contract and their assets are deteriorating. It's in the interest of the system, the Euro system, to have the ECB step in there, as it has been doing, in an open-ended, unlimited basis. The problem is they keep saying, well, we're not going to do this forever. And every time they say that, there is real worry that the whole thing can come down like a house of cards. But until now, they've been functioning in that regard. But look, you can, an individual or an entity can stay insolvent for a very long period of time if it has that liquidity to meet its liabilities on a monthly or a quarterly basis, whatever. But the whole thing can continue to get worse, which will require larger and larger injections. We saw this LTRO2, right?
Yeah.
Was bigger than the first one.
Yeah.
And the next one, when it comes along, will be bigger than the second one.
Right. So what options do we really have? Zombie banks, I guess, is one. Or I guess governments coming in and admitting that they're not willing to have a free bond market. But at the end of the day, that's socialism. So is there any way that we can return to free and fair markets?
Well, there is, and you need to have a real fiscal authority, and it has to come from the currency issuing entity, which itself is the ECB, which would require a change in the European Constitution, which would allow the ECB to step in and essentially fund national governments at some level, running deficits at some level to sustain demand and economic activity until they're basically able to grow out of this problem. But this is not the dogma at the present time. The dogma is cut, watch the economies contract, cut some more, and repeat. This is absolutely right. Einstein's definition of insanity.
Yeah.
Continue to do the same thing over and over again and expect a different result. So we're heading towards, in the end, unless, we see a change politically, we're heading towards a crash of the system, I believe. It's just a long, drawn-out process, and every time we get to that precipice where it looks like we're about to go over the edge, the ECB does step in and kicks the can down the road a little bit.